will come to order. Without objection, the chair is authorized to declare a recess of subcommittee at any time. Without objection, members of the full committee not on this subcommittee are authorized to participate in today's hearing. As a reminder, I ask all members to keep themselves muted when they are not being recognized. The staff is instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members are also reminded that they may only participate in one remote proceeding at a time. If you are participating today, please keep your camera on. And if you choose to attend a different remote proceeding, please turn your camera off. Just to get a couple of things out of the way, without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will then be forwarded to witnesses for their response. I'll ask our witnesses to respond promptly or as promptly as they are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I remind members that written questions and materials for the record should be submitted to the email address which has been provided to your offices. I want to commend Sean Caston for now being the vice chair of this subcommittee, and I will endeavor to figure out ways to transfer as many of the tedious and unpleasant duties of the chair to Sean, and we're now trying to think through exactly what that would be. This hearing is entitled Going Public, SPACs, Direct Listings, Public Offerings, and the Need for Investor Protection. I now recognize myself for 4 minutes. There are every year hundreds of trillions in securities transactions. But what matters not to investors, but to the economy as a whole, to people who just are working for a living, is when money flows into companies that they can use to expand, provide jobs, build factories. Of that money, there's 2.1 trillion going into the issuance of corporate bonds, 312 billion going in to companies that are selling stock who are already public, and 132 billion for initial public offerings. But this 132 billion of the trillions of dollars of securities transactions are probably the most important for the average American, because these are the companies that are going to make our future in the second half of this century. And that $132 billion is basically broken down between traditional IPOs and SPACs. I'll suspend for a second and ask staff to put the timer back on the screen. And then I still do not see the timer. I see the word timer would be, I now see that I have 4 remaining minutes. I'm sure that that is inaccurate, but at least the timer is now visible. In looking at these IPOs, there are 3 elements we need to look at. The first is, how is the company treated? Since our goal is to get money into companies that can expand in the future. 7% for smallish to medium-sized companies goes in underwriting fees. In a traditional IPO, a recent study shows 11% goes if it's a SPAC transaction. But what I hear most from companies thinking of going public is a concern about underpricing. That is to say, in addition to the fee, they're selling all their shares for, say, $20 a share. And wouldn't you know it, 2 days after the offering, the shares are worth 30. Who gets that extra 10? Not the company. So the company is worth $30 a share, is getting only $20 a share in the transaction. The second issue is protecting the investor. We have strict liability when a company first goes public through the traditional system. Strict liability for projections that are made about the future. But if a company goes public through the SPAC mechanism, we have a lower level of liability, unless Mr. Coates is right, and somehow it's a higher level of liability. We don't know. It's up to Congress to clarify what level of liability, what level of investor protection we have for IPOs, and it should be the same whether it's done through the SPAC mechanism or the regular mechanism. If we need to hold the underwriters accountable for misstatements about the future projections, then we needed to do it for both. If we don't need to do it, then we should do it for neither. The second issue is the investor. Well, as I was saying, I was talking about protecting the investor. With SPACs, we see 70% of those who invest in SPACs take their money out before the transaction goes forward. And then we see that those who choose to remain see their investment diluted with the pipes, the investors who come in afterwards. Finally, there is the allocation of this great opportunity to invest in the IPO, as most IPOs do go up in their first day, their first week, their first month. First, who gets these good opportunities to invest in a new IPO, and are retail investors missing out? And then second, do we have in effect a system of bribery where an underwriter can go to someone with a fiduciary duty, the CFO of a big corporation, the trustee of a large charitable foundation, and give them for their own account a chance to buy a $30 stock for $20, and then go back a month later and do business not with the individual who they've enriched, but with the big company or the big charitable trust that they control. So we've got a lot to cover. We've got a limited amount of time. The timer still shows me with 4 minutes remaining, but I'm sure that's not true. I believe my time has expired. And the chair now recognizes the chair of the full committee for a 1 minute opening statement.
Thank you very much, Chair Sherman. Special purpose acquisition companies known as SPACs or blank check companies have skyrocketed in popularity as a way for private companies to go public and avoid the public scrutiny of an initial public offering or IPO process. In 2020, the amount of proceeds raised by SPACs jumped an astounding 462% over the previous year. I have deep concerns about the lack of transparency and accountability that is a hallmark of the SPAC process, and it appears that SPAC mergers are structured to ensure Wall Street insiders receive huge profits and retail investors pay the cost. So I look forward to discussing with our witnesses what Congress and the SEC can do to better protect investors and ensure our markets are fair. I yield back the balance of my time. Thank you.
Thank you, Madam Chair, and I'll recognize the very patient ranking member for 4 minutes.
Thank you, Mr. Chairman, and you're right. I hope I have the indefinite 4 minutes, much like you did. But in a challenging global economy, the strength of our capital markets is vital to long-term economic growth. Yet regulatory burdens and bureaucracy are preventing small businesses from thriving and hindering in the United States' ability to compete globally. Small businesses, which are the fuel that powers our economic engine, make up 99% of all enterprises in the United States and employ almost half of our workforce. Prior to the COVID-19 pandemic, roughly 3/4 of all small businesses relied on financing in the last 12 months. Nearly 70% of startups received less financing than they initially requested, while 28% received no financing at all. The fact is, most people don't realize it, but 80% of business debt financing comes from investors in our capital markets, not from banks. The U.S. continues to experience a slump in the number of new businesses, which in 2016 hit a 40-year low. Last year showed a spark in IPOs that broke that disturbing trend. Until 2020, our economy launched half the number of domestic IPOs than it had 20 years ago. At the same time, the U.S. doubled the regulatory compliance cost of business incurs. Just one of the myriad reasons why the decline in traditional IPOs is the cost of going public. Costs associated with, quote, going public are high because investment bankers, lawyers, and auditors collectively charge millions of dollars to prepare the lengthy registration statement that is required to be filed with the SEC before any shares can be sold. Additionally, a series of regulatory burdens placed on public companies only adds even more costs to these companies. The SEC estimates SEC estimates the average cost of just achieving initial regulatory compliance for going public in a traditional IPO is $2.5 million, with an annual compliance cost averaging $1.5 million after that. These costs are prohibitive for small and other emerging companies focused on growing their businesses. As a result, more companies are opting for private fundraising over the costly hassle of entering our public markets. In 2016, private offerings in the U.S. raised nearly 5 times the equity as IPOs. In 1997, 8,884 companies were listed on exchanges in the U.S. Since then, the number of companies on the exchanges has decreased by more than half, which results in fewer investment choices for everyday Main Street mom and pop investors. In the U.S., there are 242 unicorns, startups with valuations of more than $1 billion that were privately financed as of November 2020. That's called a herd of unicorns. Those aren't unicorns. Conversely, as more businesses today remain privately funded instead of going public, the number of publicly held companies has declined to levels not seen since the 1980s. The decline in IPOs only hurt everyday American consumers, as I said, because there are fewer opportunities for them. It's important to note that while the U.S. IPO market has steadily decreased until last year, foreign markets, specifically China, are growing. China's annual GDP growth remains approximately 6.2% despite the recent trade war. Additionally, in 2020, mainland China was the only major economy to achieve positive economic growth. China's IPO market produced over 1/3 of the world's IPOs in 2020, reporting 536 out of the 1,363 IPOs across all global markets. Beijing's Made in China 2025 agenda lays out its plan to dominate the high-tech, biotech, and artificial intelligence industries within the next 10 years. Additionally, experts predict more IPO activity on mainland China's 14th five-year plan, which is designed to boost IPOs in specific sectors through direct financing. Increased pressure from foreign markets only heightens the necessity for immediate action and reform. Republicans support making our public markets more attractive. Make no mistake, China is aggressively pursuing policies that challenge us economically. This includes the IPO space. Republicans and Democrats must work together to continue to make our capital markets the envy of the world. Given the capital formation issues facing American companies, the decline in IPOs over the last several decades, this committee needs to be focused on legislative and regulatory frameworks that make our public markets more attractive and preserve various paths for companies to pursue going public. I look forward to hearing from our witnesses today, and I yield back.
Thank you very much. I now recognize the ranking member of the full committee, the gentleman from North Carolina.
Well, thank you. Look, if anyone, hope my colleagues wanted to discuss ways to make public companies more attractive today, they'd be disappointed. Today, committee Democrats will push more regulation, which ultimately will discourage companies from going public. That's unfortunate. What we should be discussing instead is Mr. Huizenga's proposal to facilitate small business mergers and acquisitions as an alternative to small business bankruptcy. Mr. Hill's bill to expand investment opportunities for investors who know the subject matter. Ms. Wagner's proposal to provide investor-friendly disclosure formatting and reduce disclosure costs for public companies. Mr. Emmer's bill to facilitate trading in smaller, early-stage companies to spur capital raises and reward innovation. Mr. Stiles' bill, his proposal to reduce regulatory costs and streamline disclosures for small public companies. Mr. Loudermilk's bill to remove misguided regulation and reduce costs for non-bank financial institutions. All those bills I just mentioned would do more to help investors and small businesses than the discussion we're having today. I yield back.
Thank you. Today, we welcome the testimony of our distinguished witnesses. First, we have Stephen Deane, the Senior Director of Legislative and Regulatory Outreach at the CFA Institute. Next, we'll have Andrew Park, a Senior Policy Analyst at Americans for Financial Reform. Next, we'll have Usha Rodrigues, a professor and the M.E. Kilpatrick Chair of Corporate Finance and Securities Law at the University of Georgia Law School. And finally, we'll have Scott Kupor, an investing partner at Andreessen Horowitz. Witnesses are reminded that their oral summary of their testimony will be limited to 5 minutes. You'll be able to see the timer on your screen, and I think we've now got the timer working, and it will indicate how much time you have left, and the chime will go off at the end. I would ask that you be mindful of the timer, wrap up quickly if you hear the chime. Without objection, your full written statement will be made part of the record. Mr. Deane, you are now recognized for 5 minutes.
Well, thank you, Chairman Sherman, Ranking Member Huizenga, and members of the subcommittee. I'm Steve Deane. I'm with the CFA Institute. It's an honor to be here. I'd like to focus on SPACs and investor protection. If we look at the track record so far, we see two starkly different worlds. On the one hand, we have big, sophisticated investors such as hedge funds that invest at the IPO stage, and then they exit when the SPAC announces a merger to take a company private. On the other hand, there are individual investors who buy in the public markets, often at the time of the merger announcement, and hold their shares in the post-merger period. These two sets of investors face two starkly different results. Their lucrative profits for the sponsors, as well as the hedge funds who exit, but poor returns for ordinary investors who stay on. The question is, are there any design features of SPACs that could explain this pattern? And I'd point to three. First, dilution. The initial IPO investors, including hedge funds, buy SPAC units, which consist of shares and warrants, but those warrants are detached after about 2 months. So later, in the second phase, when these investors redeem their shares, and most of these hedge funds do, they get their money back plus interest, but they get to keep their warrants. Now, one academic paper calls this, quote, a default-free, underpriced convertible bond with extra warrants, end quote. In other words, a free lunch. But we know there's no such thing as a free lunch. It comes at the expense of the investors who hold their shares in the post-merger period. That includes retail investors. So dilution's a handicap, and it's one that the record shows that SPACs to date have not overcome. The second investor concern involves misaligned incentives. For example, the sponsor has a strong financial incentive to make a merger deal, even a bad one that may not be in the interest of the other shareholders. In addition, the SPAC may offer special inducements such as discounts to get still other investors to invest in private deals called PIPEs. The details of these side deals are not always disclosed. The third area of concern involves forward-looking statements. SPACs enjoy a safe harbor, at least it's been thought of till now. They enjoy a safe harbor from private litigation if they make a forward-looking statement or projections about the future of the proposed merger. That's different from a traditional IPO, which gets no safe harbor and therefore almost never offers forward-looking statements. This heightened liability in IPOs is an important investor protection. The question is, why doesn't this same investor protection apply to SPAC mergers? So where do we go from here? Well, first, we've seen an explosion of SPACs, and now they're facing heightened scrutiny, including this hearing. That's a good thing. Public education is an important component to help protect investors. As SPACs evolve, we may see market solutions to address some of these concerns. But there's also a clear role for Congress and securities regulators to remain vigilant to protect investors. As Congress deliberates on possible actions it may take, we'd welcome the focus on investor protection and transparency. And specifically, I'd suggest focusing on dilution, misaligned incentives, undisclosed side deals, and safe harbors for forward-looking statements. Thank you.
Thank you, Mr. Deane. Mr. Park, you're now recognized.
Thank you. Chairman Sherman, Ranking Member Huizenga, and members of the subcommittee, thank you for inviting me this afternoon to share my views on the different ways that private companies have been choosing to go public outside of the traditional IPO process. My testimony today will focus in particular on the rise of SPACs. Over $100 billion have been issued so far this year, or nearly 10 times the total that we saw in 2018. This exponential growth is concerning because SPACs historically have performed very poorly for retail investors, all while the issuers, advisors, and a select group of institutional investors will still profit. The SPAC surge appears to be driven in part by private companies' desire to exploit the perceived speed, a higher streamlined disclosures, reduce liability, and reduce shareholder rights that are offered by the SPAC process. So although many SPACs have just, although many have just started hearing about SPACs recently, SPACs are really far from new. In fact, they actually date back to the 1980s when they were actually called blank check companies, and they were often associated with scams, and in the process, bilking unsuspecting investors out of millions of dollars. And so fraud was, in fact, so pervasive in these blank check companies that Congress, back in 1990, had to pass the Penny Stock Reform Act to address some of these problems. The SEC followed shortly thereafter with Rule 419 that also dictated blank check company rules. Blank check company issuers, though, decided that they would get around these rules and devised this modern-day SPAC structure, reminding us that properly regulating new assets requires both continuing attention and action. And there are two main ways that SPACs escape from coverage from both the PRSA and also Rule 419. The first is this arbitrary $4 a share threshold that defines a penny stock. And second, the extremely low standard of $5 million in net tangible assets. Neither of those conditions end up applying to SPACs because everyone holds more than $5 million in cash, and they are deliberately issued at $10 a share to get around that $4 mark. SPACs also rely on a safe harbor from being held accountable for forward-looking statements under the Private Securities Litigation Reform Act of 1995. Whereas in an IPO, issuers and underwriters are liable for making false and misleading forward-looking statements, SPACs are not subject to that same standard. That has emboldened many pre-revenue companies in highly speculative industries such as electric vehicles, cryptocurrency, and space exploration to use what we could generously call rosy projections. Take, for example, 9 electric vehicle companies that have come public through a SPAC in 2020. Their combined annual revenue was $139 million that year. But between them, they project to investors that by 2024, they will generate $26 billion in annual revenue. Or let's take a look at a space exploration company, Holicity, who is proposing a merger with Astra Space. They have disclosed to investors, for example, that they have not launched any rockets. Yet, by 2025, they project that they will have daily rocket launches. What's most concerning is that retail investors are buying into this type of hype, and in some instances pouring a significant portion of their savings into certain SPACs when the data continues to show time and time again that they perform poorly over the medium and long run. A large part of that underperformance comes from the sizable upfront compensation that goes to the sponsor, who receives that 20% promote regardless of the quality of the acquisition. So as a result, when you look at the average SPAC that is issued at $10 a share, after you pay the sponsor and you meet the redemptions of the shareholders who want to cash out, that SPAC only ends up with $6.67 in cash after the merger. Or put another way, that would mean that the value of the company would need to rise 50% just to get back to that $10. And that leaves many of the retail investors who hold this post-merger SPAC at a significant disadvantage. Now, we wouldn't want people's 401ks to be used at the blackjack table, given how the game is mathematically stacked against them. But unfortunately, investing in SPACs in their current form is not too different. And I'll add my remarks with these figures that show just how clearly the house always wins. The average SPAC sponsor between 2019 and 2021 saw returns of 958%. The average institutional investor who is doing this arbitrage trade, which I can later elaborate on, averages a 40% return. But now retail investors who chase these SPACs with the high hopes are losing. And so if we look at between 2010 and 2018, the average one-year return of SPACs following a merger was negative 15.6%. Even more recently, Goldman Sachs found that 200 SPACs in April lost around 17% compared to a 10% return. Given these dramatically misaligned incentives that characterize these deals and their extremely poor performance, we urge the committee to take action. We urge you to amend the Exchange Act to align the rules that govern forward-looking projections in SPACs with those of IPOs, and to broaden the definition of blank check companies to better protect Main Street investors. I thank you for your time, and I look forward to answering your questions.
Thank you, Professor Rodrigues.
Chair Sherman, Ranking Member Huizenga, and members of the subcommittee, it is an honor to participate in today's hearing. Because my time is limited, I'm going to highlight just 2 aspects of my written testimony. I'll use a somewhat offbeat metaphor and then an analogy that I think might hit home. First, the metaphor. The subject of this hearing is going public, and I'm going to propose to you that you think of the traditional IPO process like a traditional wedding. Most of us have attended many weddings. You know, the couple picks out the date months in advance. There's an announcement, there are elegant invitations, the venue is selected with care, and so are the flowers, the photographer, the caterer, the dresses. The couple's family will meet and perhaps help with planning the ceremony. It is quite a process. Well, how is an IPO like a wedding? Well, an IPO also starts out months ahead of time. The CEO, the CFO, the general counsel have likely been dreaming for years of the day when they can take their company public. Once they decide they're ready to embark, they interview a series of investment banks and select the right one to lead the offering. The lead underwriting bank then shepherds the company through the process. It works with the company to draft the registration statement, which it files confidentially with the SEC. The SEC comments on the draft, the company responds, they go back and forth several times. Finally, the company files its first public registration statement. But that isn't the end of the story. The banks and the company then launch a roadshow in which they try to explain the company's business to interested investors and convince them to invest in the IPO. The SEC continues to comment, asking for clarification, for adjustments in wording. Finally, the SEC signals that it has no more comments, and the bank is comfortable that it can sell the offering and the prospectus is free of material misstatements. Then and only then will the offering price and the IPO commence. Now, if an IPO is a traditional wedding, then a SPAC is more like a Vegas wedding. It just doesn't have the same level of preparation and vetting that a traditional IPO does. But here's the point. It's still a legal wedding. Whether it's Vegas or traditional, at the end of the day, you still have a lawfully married couple. And that's just like whether a company goes public via a SPAC or via a traditional IPO, at the end of the day, it's a publicly traded company. But these are the products of two very different processes, and it is misleading to try to equate the two. That is why I support prohibiting forward-looking statements in a de-SPAC and extending Section 11 liability, underwriter liability, to include the de-SPAC disclosures. These reforms will help to equalize the process. Okay, that's my offbeat metaphor. Here's my analogy. As I described in my written testimony, SPACs used to allow a vote in the de-SPAC so that SPAC shareholders got a say in whether or not to make the acquisition. And if enough of them said they wanted their money back, 20% to be precise, then the deal wouldn't close. After all, the SPAC needed the money from the trust account to fund the acquisition. Now, the rules changed, and I don't have time here to get into why, but they did. And now just a majority vote is required, except sometimes a vote isn't required at all. And what actually troubles me isn't the elimination of the vote, it's how meaningless the vote is when it does occur. And that's because SPACs allow shareholders to vote for the acquisition and still redeem their shares. As a SPAC shareholder, you can basically say, sure, I think we should acquire this company and take it public, but I don't want any part of it. Give me my money back. And that takes me to my analogy. This is like a US citizen voting in an election, say a congressional election. Except this citizen is in the process of renouncing their citizenship while they are voting. They vote, but they have no interest in the outcome. I suggest that this decoupling of voting and economic interest is a real problem that you should consider. This concludes my remarks. Thank you again. I look forward to your questions.
That is perhaps the most interesting presentation I've heard in a while. Now go on to Mr. Kupor, who's recognized for 5 minutes.
Great. Thank you, Subcommittee Chair Sherman, Ranking Member Huizenga, and members of the subcommittee. Thank you for this opportunity to talk about this very important topic. Before I give you some perspectives on potential reforms to consider in order to enhance capital formation, and access to investment opportunities for all Americans. I'll briefly summarize a few trends that haven't yet been touched on in this setting. First, I think we shouldn't lose sight of the fact that the raw number of IPOs has declined significantly. From 1980 to 2000, we used to do about 300 IPOs per year. From 2001 to 2016, that number fell to about 108. Second, companies are staying private longer, roughly double the time period they used to, and therefore we have more mature and obviously higher valuation companies at the time of the IPO. Now, I think it's a reasonable question to ask, which is why should we care about any of this? First is the number of publicly listed companies in the US has declined by 50%, which reduces competitiveness and overall consumer choice. Secondly, publicly traded companies, we know, drive employment growth and are the key to expanding geographic access to economic opportunity. And thirdly, and I think very importantly, the vast majority of appreciation of high growth companies is now accruing to institutions, pension funds, and wealthy individuals who can invest in the private markets, while retail investors are largely relegated to the public markets. This two-tiered market structure has significant implications for income and wealth inequality. Now, there is some good news, which is we've seen some positive developments. The number of IPOs has been steadily increasing in the last few years. And no doubt some of this is due to the work that many of you were instrumental in as part of the passage of the Jobs Act. So we appreciate that and thank you for your efforts. We also now have choice, which is really important. So traditional IPOs now compete alongside direct listings and SPACs for quality issuers. And choice is good. It drives competition, it reduces expenses, and enables more companies to seek capital to grow their business. However, to ensure that choice and competition thrive and that all investors have access to growth opportunities, that the U.S. continues to create new jobs and economic growth, and that the U.S. remains the best place for company formation and growth, there are a number of things that I believe legislators and regulators should consider. First of all, we should consider how can we make it easier for companies to go public and to do so at earlier stages of maturity. Expanding the current Jobs Act EGC eligibility criteria for issuers from 5 years to 10 years, as noted in the Helping Startups Continue to Grow Act, would help smaller cap companies on-ramp into the public markets. And providing a transition period of 1 year for EGCs who trigger the large accelerated filer status when public float exceeds $700 million for the first time would also help. Secondly, we have to be mindful of the fact that very low volume small cap stocks are especially vulnerable to short activity. And so this body should consider short position disclosure similar to what exists for material long positions to support innovative small capitalization companies. Another way to enhance liquidity would be to look at the opportunity for EGCs to opt out of unlisted trading privileges and therefore select the venues on which they want to trade their securities and consolidate trading volume. Secondly, we ought to ensure that the choices persist for going public and that they engender fair competition, enhance price discovery, and broader retail participation. With respect to direct listings, one of the very important things for clarification is around the tracing rules and Section 11 liability. There is some uncertainty around this for selling shareholders, and this is potentially preventing direct listings from achieving their full potential. You've heard a lot already about SPAC, so I won't comment on that, but I think Chairman Sherman, you noted, I think, the most important thing, which is we should have a level playing field. Whatever this body determines, it should not be the case that there should be different regulatory regimes for traditional IPOs relative to SPACs. Third, while enhancing the public markets, I think we also need to look at ways to enhance access to the private markets for non-institutional investors, obviously with appropriate oversight and investor suitability. While the SEC has taken some initial steps towards amending the accredited investor definition, I think there are more ways that we should expand that to materially increase the number of individuals who would qualify. Secondly, we might consider making it easier for retail investors to access private fund investments. Models such as that proposed by Representative Gonzalez could enhance retail access to private high growth companies. And finally, there's another area of capital formation that hasn't been touched on here, which is around blockchain and crypto industries. In many ways, a healthy blockchain ecosystem not only creates economic growth and technological development for the US, but it's also an opportunity for anyone who desires to be part of a project to benefit from the success in that endeavor. Unfortunately, to date, the SEC has not provided clear regulatory guidance for how tokens will be treated under existing regulatory rules. This is important because we need to differentiate between good faith technology entrepreneurs and get rich quick schemes and make sure that this is very clear to others. I appreciate the opportunity to be here and look forward to your questions.
Thank you. I want to thank our witnesses for their presentation and recognize myself for 5 minutes. I'm going to be interested in all of our witnesses presenting for the record their ideas on how we can reduce the costs that the companies face, because we need more companies to decide to go public for all the reasons that have been outlined. And when I talk about costs, it's not just the commission that is shown, but also under pricing or anything else that prevents the company from benefiting from all the dollars invested. I want to thank our last witness for recognizing that we ought to have the same liability system, whether you choose the SPAC route or the IPO route. Either we want to encourage companies to speculate about the future so that we at least get some information or some speculation, and avoid and tell them they're free to do so without strict liability, or we want to tell all investors that you're protected, and that any forward-facing statement will be subject to all the protections of Section 11 liability. I want to focus on the use of the IPO as a way, in effect, to bribe those with fiduciary duties. The public spends a lot of attention making sure that members of Congress who owe fiduciary duty to our constituents and the people aren't taking gifts. And yet there's also a private sector where every corporate officer owes a fiduciary duty to the corporation. We have charitable trusts, we have pension trusts. And it occurs to me that if I was in the investment banking business, I would love to do business with a $100 billion pension trust. And if I were to go into the trustee's office with $100,000 in a briefcase and say, and I'll be bringing you similar briefcases from time to time, no quid pro quo, just like bringing you briefcases full of money, my guess is that I and the trustee would go to jail. But if instead I call the trustee and say, look, for your own account, you may want to invest in this hot IPO. I won't make it available to any but my best friends. And no quid pro quo. It's just every month I'm going to give you another good IPO. You'll make about $100,000 from the shares I allocate to you. And oh, by the way, I'd like to in some other conversation talk to you about your $100 billion fund and how we can be of service. Professor Rodrigues, does that work? Is that legal?
It's a practice called IPO spinning, and it's not legal. It's the allocation of IPO shares from the syndicate to investors is a really opaque one. You know, I was looking on.
If I can interrupt, Professor.
Yeah, of course.
It's kind of known that the underwriter can make this opportunity available to their best customers. We like to think the best customer is the one with a $5 million account. But if you've got a person who has only a $50,000 account, but they happen to be the trustee of a big charitable trust, can you treat them as one of your good customers?
Well, yeah. So I was looking on the Fidelity website, and it says customers who want to participate in an IPO offering are evaluated and ranked based on their assets and the revenue they generate for their brokerage firm, right? So it is clearly a system where.
Okay, so that's a system whereby it's just what you generate for the firm. Would it be illegal to say, or what you generate for this firm through the accounts you control? Is that, I mean, if I did, I don't think Fidelity does it that way, and I would put it in writing if I did, but would it be illegal for them to say, well, you generate a lot of money for our firm because you're the trustee of the big trust?
I think it would. It certainly is a ethically questionable practice.
I look forward to trying to draft legislation to make sure that not only is it illegal to bring the fiduciary a briefcase with $100,000 in cash, it's also illegal to bring a fiduciary a chance to make $100,000 profit that is not available to the other customers of the brokerage. And with that, I will call on our next witness, our next questioner, who will of course be our ranking member.
Thank you, Mr. Chairman. First, I'd like to ask unanimous consent to enter into the record an article written by Jennifer Schlupp entitled IPOs, SPACs, and Direct Listings, Oh My.
Without objection, so ordered.
All right, thank you. Mr. Kupor, today's hearing is focused on three primary pathways for going public: traditional IPO, the SPACs, as well as a direct listing. Will you please discuss each of these three pathways to go public and why one may be more attractive or advantageous over another, depending on a company's specific circumstances and needs at the time?
Yeah, sure. Thank you very much for that question. Yeah, so in general, let me take them one by one. So the promise of SPACs is that the process typically can be faster for companies because you already obviously have a public vehicle. And there's more certainty around the initial pricing because you pre-negotiate, obviously, through the merger and the de-SPAC agreement, as well as a PIPE, what the valuation is. So that's been the promise. I would say so far, if you look at the data, that's generally been true, which is the time frame has been faster. I will note, and I mentioned this in my written testimony, that of late, we've seen, obviously, things slowing down at the SEC, just given the volume of SPACs, and that's created some more uncertainty around market timing. We've also seen the PIPE market very, very different in terms of being much less robust than it was even just a couple months ago. So that timing question kind of remains to be seen. Direct listing today is most relevant for companies that do not have to raise primary capital. Now, there is, as you know, the opportunity for companies to raise primary capital, but to date, we've only seen secondary offerings. So the direct listing tends to be most attractive for companies where they don't need access to primary capital, and in general, where there is enough what I would call awareness and brand of the company so that they can effectively be able to come public through a lesser marketing process. And then traditional IPOs, again, is mostly today being taken advantage of by companies who need access to primary capital. That's really the main reason. It's obviously a heavier weight process from a regulatory perspective. It certainly takes typically more time, but it does have that effect. So I think, what's important in this discussion, which I don't think we should lose sight on, is that this choice really matters, is very important. And we're already seeing market responses to these choices being available. So, sorry, go ahead.
Expand on that. It's my understanding that you have helped bring a number of companies public. And so talk a little bit about the why. Why do they want to go public? Why are some of them choosing to not go public? I mean, we talked about these unicorns. See, I always say, if you've got 240 some odd unicorns, they're not unicorns. Those are a herd. and there's a reason why that they are doing that. And we can't seem to come to an agreement on both sides of the aisle as to these massive costs or what it is that's keeping that. But I'll ask this last part if you want to touch on that. But what kind of concerns do you have about the SEC or Congress making it more difficult or less attractive for companies to go public via these three pathways?
Yeah, I have a lot of concerns because I think it's really important for us to have more public companies. And so to give you just a few specific thoughts, one of the issues that companies are staying private longer is because it is very difficult to be a small cap company today in the public markets. You don't have research coverage. You tend not to have sales and trading activity happening at the banks. You obviously do have regulatory burdens, but I would say the regulatory burdens are a little bit of an upfront cost often. But the real question is, once you are a public company, what's it like to be a public company? It can be very lonely to have a very low float, not well followed stock. So some of the things that I think that I mentioned in my testimony we could do is to think about how do you increase liquidity and volume of activity for small cap stocks in particular. So I think that's one really important area. Secondly, we do want to have more public companies. One of the beauties of this country has been that the capital markets here are the envy of many across the world. And if you look just quite frankly at what we've seen, even in this horrible crisis of COVID, companies like Moderna, the reason we have vaccines is because companies like Moderna were able to both tap private capital and then quite frankly tap public capital in a way that gave them access to tremendous research and development dollars that's now resulted in what is today, quite frankly, a medical miracle. And there's a whole host of companies doing that. So the most important thing that I would ask this body to think about is before we introduce additional regulation, I think I would ask the fundamental question, which is, does that regulation help or hinder access to capital markets for companies? And then secondarily, does it help or hinder access for retail investors to be able to actually access these opportunities?
Yeah. Well, in my closing seconds, I know that these are the questions that we have. We need to pursue these and make sure that we remove those barriers, not put more up. So with that, I yield back.
Thank you. We'll now recognize the chair of our full committee, Maxine Waters. Maxine? I don't know if the chair of the full committee is available. I'm going to go to Mr. Himes, and we'll come back to Chair Waters. Mr. Himes.
Thank you, Mr. Chairman. Thank you for holding the hearing, and thank you to our witnesses. We've been talking a lot about investor protection in the context of Robinhood. There is a dispiriting dialogue on this committee where the Republicans accuse the Democrats of wanting more regulation. When that dispiriting dialogue happens, we forget to focus on something that I think is particularly important in this realm, which is remarkable rent-seeking behavior. And by rent-seeking, of course, I mean taking advantage of oligopolistic situations or information asymmetries or dislocations in markets to make money, which you wouldn't otherwise make in a competitive scenario. I do think that an awful lot of investors, as Warren Buffett says, you don't know who's swimming naked until the tide goes out. And the tide really hasn't gone out much in the last couple of years. And I do think that investors at some point are going to get a very expensive education in the fact that equity markets don't go to the sky. But I don't think that absent shining a light on or considering regulatory behavior, we're going to see a decline in the amount of rent seeking. It hasn't been mentioned, but for a long time, I've been banging the drum on the fact that if you do an IPO between roughly $30 and $150 million in proceeds, the mid-market IPO, you always get to pay a 7% gross spread. That has never felt to me like competitive activity. There is another area that has been mentioned this morning, and I'd like to highlight it for a minute or two, maybe with starting with Mr. Deane, and that is IPO pricing. I used to do IPOs for many, many years, and we always used to celebrate when you were 10 times oversubscribed and you priced the IPO at exactly half or 1/3 of what the value was on the second day of trading. It always struck me that that was a way to leave an immense amount of values that might have otherwise gone to the limited partners at Mr. Kuper's organization or to the company itself. So, Mr. Deane, too much preamble there. Talk to me a little bit about pricing behavior and who benefits and when IPOs are underpriced. And I'll open this up once you're done to anybody. Is there any long-term fundamental value in having a big IPO pop, long-term fundamental value? Mr. Deane.
Thank you, Mr. Himes. Actually, I know that Commissioner Jackson has often, and Professor Jackson has often made the same points that you had about the 7% tax and competitiveness. I guess first I'd say on the one hand, IPOs offer tremendous strengths in investor protections, including Section 11 strict liability. On the other hand, they just don't seem to be perfect, and you've identified one of the big issues is that are the issuers leaving money on the table through the POP, which is the extra price that the investors that the shares trade at in the first day, and also a seemingly uniform 7% cost for the IPO. And it does seem to me that some of these other things we're seeing, like SPACs and direct listings, maybe they're identifying some underlying problems, even if the SPACs themselves have flaws, even if they're not the perfect answers. Maybe we also have to ask, what are they telling us about the market that could be improved? So again, on the one hand, I think, yes, these are problems. In my opinion, these are problems with IPOs. The issuers are leaving money on the table. On the other hand, I would reiterate, they also come with some great strengths in investor protection.
Thank you, Mr. Deane. Professor Rodrigues, I saw you nodding away there. Give me 30 seconds, because I do have a question for Mr. Kupor. Give me 30 seconds on the value of a very substantial IPO pop.
Well,
And who gets that value?
the first day, the investors, right? The investors in that initial IPO get a huge bump. They get a huge rise in value on one day, right? One day.
And to go with your metaphor, the investors are the guests at your wedding. Does every guest at that wedding get an equal chance to see that day one doubling in value?
Let's beat this metaphor. Okay. So no.
Or let me put it that way. Some people weren't invited to the wedding, right? Lots of people weren't invited to the wedding, and I'll lead the witness here by saying usually those are the retail investors, right?
Right. So the syndicate, the banks, get the value of having their customers be happy with them because they've gotten this initial first day pop. Those are the winners, and then the losers are everybody who has to buy at the real market price.
Which is generally retail investors investing a couple of weeks after you've seen that pop, and an awful lot of institutions have actually made an awful lot of money, correct?
That's exactly right.
Yeah, thank you. Mr. Kupor, I'm sorry I don't get to go to you. My time has expired and I yield back.
I point out the company might also be losing if they underprice the shares, and I'll go to Ms. Wagner for 5 minutes.
Thank you, Mr. Chairman. Mr. Kupor, I'll go to you. Would you agree that being a public company comes with additional disclosure and filing requirements that can often deter a private company from going public?
Yes, I think that's a fair statement.
In your experience, and I know your experience is vast in this, from taking private companies public, what are some of the specific overburdensome regulatory requirements, specifically filings and disclosures, that you believe make going public less attractive to a private company?
Yeah, some of the things that were identified in the Jobs Act, this, the EGC status of being able to defer some of the SARBOX requirements obviously is very helpful and valuable, and those things can be burdensome, particularly for small cap companies where you're really trading off regulatory dollars versus R&D dollars. There are other things like say on pay and other kind of disclosure items, kind of that I think are challenging as well for some of these, particularly smaller cap companies. But as these companies get much larger, many of those things are much more manageable.
There certainly is more work that this committee should be doing to make our public markets more attractive, to increase the number of companies going public, while also, very importantly, preserving investor protection.
Absolutely.
One way to help increase IPOs is by simplifying the quarterly financial reporting burden on companies. In recent years, quarterly reporting requirements have grown in size and complexity, making it much more difficult for investors to determine, I think, relevant information, often leaving them overwhelmed and unable to make sound investment decisions. Furthermore, some companies believe that current reporting requirements have become a barrier to registering as a publicly traded company, as noted by a report by the IPO task force. The report, which was promoted by the Jobs Act that you mentioned of 2012, found that 92% of public company CEOs said that the administrative burden of public reporting was a significant challenge to completing an IPO and becoming a public company. It is time, past time, to move away from this one-size-fits-all approach to corporate disclosure and focus on transparency through new technologies and the flexibilities that I think new technology have allowed us. The current disclosure rules were written before the advent of websites and social media and direct connection to investors that comes from the ubiquitous access of even just smartphones. I believe that you can reform disclosure requirements without depriving investors of any critical information that they may need or that they absolutely deserve. That's why I've introduced the Modernizing Disclosures for Investors Act, which would require the SEC to implement rules simplifying the quarterly financial reporting regime for SEC registrants. My legislation would allow issuers of securities traded on a national securities exchange to disclose quarterly financial information in a much more simplified manner and reduce some of the administrative costs that are deterring small and mid-sized companies from going public. And I would certainly urge my colleagues, especially here on capital markets, to co-sponsor this legislation. And Mr. Kupor, in my limited time that I have left, is it beneficial for businesses to have multiple pathways of going public, and why?
Yeah, it absolutely is. And the good news, as I mentioned in my testimonies, we are seeing that now. So, there are some issues that many of the panelists have raised here around SPACs, and I think those are worthy of discussion. But the idea that we now have SPACs, we now have direct listings, and we have traditional IPOs really is helping from a market perspective. So even in some of the comments that were mentioned earlier by some of the members here, things like IPO pricing has actually improved. If you're concerned about pops, those pops have actually gone down as a result of greater competition. We are getting better price discovery in these mechanisms. And so to me, the most important thing to preserve is competition and choice. And if we do that alongside, as you mentioned, Ms. Wagner, investor protection, then I think we have a very good shot at remaining a very important capital market center.
Great. Thank you very, very much. I appreciate it, Mr. Chairman. I yield back.
Thank you.
Thank the witness for mentioning direct listing, and I'm hoping that questioning will focus more on that. And I now recognize the chair of the full committee, Ms. Waters.
Thank you very much, Mr. Sherman. Mr. Park, in a letter sent to the House Financial Services Committee, the Consumer Federation of America and Americans for Financial Reform note that initial SPAC sponsors and hedge funds that are granted exclusive access to the early investor pool are granted, quote, attractive investment returns for an essentially risk-free investment while avoiding the disclosure obligations and liability risk associated with the typical IPO, end quote. The letter notes that these initial investors who sell or redeem their shares before the SPAC merger receive, on average, an 11.6% rate of return, while the SPAC sponsors themselves, quote, perform even better, earning a mean return of 32% in the 12-month period post-merger. However, unsurprisingly, retail investors and the rest of the market appear to have a much different experience. Reports show that 90% of SPACs that announced deals this year are lagging the S&P 500 based on when they began trading, and according to a Reuters analysis, quote, the median performance of a SPAC from the day it announces what company it will merge with, though now is a decline of 6%. Why is it that once again it appears that Wall Street and hedge funds are profiting while retail investors are left bearing the cost? A lot of talk has been given about this already, but what I would really like, instead of answering that question, I'd like to know, can you explain the protections and safeguards that are part of the traditional IPO process that are absolutely absent from the SPACs, and how this may affect investors, particularly retail investors? What is it that investors have access to with the IPO that they don't have with the SPACs?
Well, thank you for that question, Chairwoman Waters. I'd say, first off, the key critical component that's missing is information, right? So when investors are buying into these SPACs at the initial offering, they don't have any insight as to the financials, nor really necessarily what the business is going to be. And so what they're doing is that they're putting their faith in the sponsor to be able to find a good deal for them, or ultimately a good company to merge with. Now, the problem here is that when it comes to the process where the SPAC has finally identified a company to merge with, there's supposed to be a vote in place. But what we find is that a lot of the initial investors are more interested in voting for the merger and then selling their shares because they know that they can still profit. They can do so because when you originally buy into a SPAC unit, as Mr. Deane was saying in his testimony, you get both the shares and you get these warrants. And so if you sell the shares, and you still vote for the merger, you can still hold on to these warrants. And so what happens with the warrants is that if the stock were to go above $11.50, you can still make money, even though you did not, you don't still own the shares, but at the same time, you still voted for the merger, right? So that conflict right there seems to be very odd. And now keep in mind too, with the compensation structure of these SPACs, as I was stating in my testimony, the sponsor, upon completing a deal, gets 20%. They're not evaluated necessarily on whether it's a good deal, but whether it gets completed. They collect that, right? And then otherwise, there's also these other sets of investors that come in later called the PIPE investors. They have a different set of securities that they're invested in, and they have a different set of interests. So all throughout the whole SPAC process, everyone has their own set of incentives where they can make money.
Okay, let me just ask you before my time is up. Mr. Sherman has legislation dealing with precisely what we're discussing, making sure that more information is available, et cetera, et cetera. Have you seen the legislation, and do you think it is what we need? Do we need to make it tougher? Do we need to add to it? Have you examined that legislation of Mr. Sherman's?
Yes, I have, Chairwoman.
What do you think?
And so it's certainly a step in the right direction. I mean, we're really going after these forward-looking projections that are being abused, right? That is the core component of what differs between an IPO and a SPAC. And on top of that, I'll add the fact that there are reasons why Rule 419, which dictates blank check companies, was put into place, again, to protect investors. And we are asking the committee to also consider aligning SPACs with blank check company rules.
Well, I thank you so very much for all of our witnesses that are here today, and I yield back the balance of my time.
Thank you. Now recognize Mr. Hill.
I thank the chairman. Appreciate you holding this hearing. And it's, of course, I think no surprise to any of the members that with interest rates at negative returns due to artificially keeping our interest rates too low and fueling a major fiscal injection in our economy and the GDP at the growth rate that it's projected to be this year, and our big companies announcing outstanding earnings, I think it's no surprise over the last 5 months that we've concentrated on some of the excesses that we've seen out in the capital markets of people taking advantage of this unprecedented expansion in the capital markets due to, I think, the monetary policy. So with that, I do share Mr. Huizenga's goal that we need to be thinking long term, which is how do we bring down that marginal cost of going public and staying public? Of course, we want that going public to be done in a fair and transparent way, but the real issue is that ongoing cost of being public and continuing to stay public and try to lower that as much as we can, consistent with our obligations to the investing public. So I appreciate Ranking Member Huizenga raising that point. And when I think long run, we need to get that ecosystem of both private company capital formation and public capital formation really looked at closely so that we encourage the U.S. to be our preeminent capital market. One thing I wanted to concentrate on in this hearing today is a bill that I've introduced with my friend, Mr. Schweikert of Arizona. I've introduced this bill during my time in Congress, and it's gotten a good report in the past and previous Congresses, and it speaks to expanding the access to investors by expanding the definition of an accredited investor to include professional expertise. And we've introduced that in the 114th Congress. That bill passed favorably by the committee with a strong bipartisan support and received 347-8 vote on the House floor. It also received strong support in the committee during the 115th Congress and a voice vote on the House floor. But with the change in the majority in the 116th Congress, this bill did not receive floor consideration, and I hope, Mr. Chairman, we can do that. Mr. Kupor, I believe you've had a chance to review the legislation. You and I have talked about the importance of accredited investment definitions before. I wondered if you'd reflect on what the commission's done, and do you think the bill that Mr. Schweikert and I are proposing would aid investors that have the professional qualifications and knowledge to be a bigger participant in that accredited investor rule in a private placement?
Yeah, thank you, Mr. Hill. Yes, I have reviewed it, and I agree with your general proposition, which is in addition to figuring out how we have more companies going public, we also need to figure out how we actually increase private access participation for more investors. And I do think expanding the definition of accredited investors would be very helpful. One of the things that also could be considered if you wanted is in the crowdfunding legislation that was part of obviously the Jobs Act. This Congress decided that there were certain dollar limits, for example, that they were comfortable with even unaccredited investors investing in that market. And so another potential way to expand access to investors in the private markets would be to adopt that language and give people, for example, a set number of dollars that even unaccredited investors could invest in the private markets. And then finally, I think we've discussed this as well. The other way to help increase private market access for unaccredited or even accredited investors under a new definition would be to look at expanding kind of fund level investment opportunities by giving people the benefit of kind of professionally managed funds and revisiting, for example, the 3C1 limitations on the number of accredited investors that are currently limited to 100 in those funds. Those, I think, would expand access as well.
Yeah, that's helpful because I think we want to do both. I think we want to make sure that our public investors through 401ks and through their IRAs and through their company pension plans, they have more opportunities, as you outlined, to invest in public companies. Those number of public companies cut in half over my business career. But we also want to safely give them opportunity to participate in a private market if, in fact, as you argue, companies are staying private longer. Give me one thing that would lower that marginal cost of being public, so that a small or mid-cap company might be inclined not to wait till it's huge to go public. What would be the top thing for you?
Yeah, look, to me, I think the framework that this Congress laid out on the EGCs is the right framework. And so if you could extend the time period under which those issuers could take advantage of the lighter regulatory environment for the EGCs that exist today, I think that would be very meaningful.
Good. Thank you so much. I yield back, Mr. Chairman.
Thank you, sir.
Thank you, and recognize Mr. Foster.
Thank you, Mr. Chair. Am I audible here?
You are indeed.
Okay. Well, first, just two quick comments on the thing we've been struggling on this committee for quite some years, which is who's going to pay for the research on a small cap firm at the edge of going public. There's an asymmetry because wealthy private equity investors, have the wherewithal to look into details. When they're talking about investing in a potential unicorn, they can look and ask if the intellectual property is sound and defensible in court. That's never going to be cheap or easy or transparent. But it is a real cost, and someone ought to do it at the point that the issue goes public, because the retail investor is not going to have the wherewithal to do that kind of due diligence. And a second general comment on it, I think it's very often pointed out that that maybe one of the drivers of wealth inequality is the asymmetric access. I think it may actually be the other way around. That when you have an increasing concentration of wealth at the top, then those are the people who can realistically make private equity type investments, which are the high risk, high reward investments. And so that the problem is at least feeding on itself, and that we should look at it from both sides of that coin. Okay, now I really appreciate the argument about the benefits of competitions between IPOs, direct listings, and SPACs. That has to be part of a good solution to this. But the question I have, do we know at this point enough to define what a safe, sound, and economically efficient SPAC looks like in an effort to at least carve out a subset of SPACs that are really reasonable things to invest in? Can we define those? This huge boom in SPAC listings has given us a lot of data. And is it, so do we know enough? Anyone want to sort of, grab that and try to say, what are the essential things that we could do? And is it a wise thing to try to split off part of the SPAC market into well-regulated, responsibly run entities? We'll start with weddings. Yeah, well, let's start with weddings. How do you make weddings less likely to end in divorce and happiness?
Well, so I'm studying SPACs right now. I'm studying the current crop of SPACs right now. I'll have better answers when that study is concluded. I'll say, I think all of the witnesses are in agreement that we need to equalize the regulation so there isn't this regulatory arbitrage. It shouldn't be that it's easier, that the liability is different or the disclosure level is different in one versus the other. So once that's done, I think a lot more disclosure. I'll tell you, I'm looking at these disclosures around the merger right now, and they are incredibly complex. I can't really understand them, and this is what I'm doing every day. They're opaque, and I'm not sure exactly whose money is coming in and what their interests are. So standardizing disclosure, and then the final thing that I think would make SPAC safer is to make it a real vote, to have there be a real vote from the market, so that if 50%, this was the intention at the outset of the form, if 50% of the SPAC shareholders want their money back, then it's not a good acquisition and it shouldn't go forward. But if more than 50% are willing to stay in, that's a market test. And I'm looking at the empirics, but that's where I am right now.
Any other comments or suggestions?
Mr. Foster, if I could comment on your earlier comments, you mentioned two things that I think that were very important. One was you mentioned who will pay for research for these small cap companies, because it is very critical. And I do think fundamentally this goes back to, is there an economic incentive for this through making sure that these stocks trade and they have appropriate volume and liquidity? And so some of the suggestions that I brought up around UTP suspension, and also looking, quite frankly, at the global research settlement and making sure that there aren't impediments to research coverage that may still be stemming from that. And then if I could just also comment on the second thing you mentioned, which is, wealthy individuals being able to access private markets. I 100% agree with you. That is a real issue. And I think that's why, again, this body should consider, how could you improve retail access to the private markets in addition to all the good work you're doing around IPOs. So thank you for bringing those up.
So if I could,
I would just also speak, when you ask about how we could identify better SPACs, they're evolving. I talked earlier about the dilution, the misaligned incentives. I see the time is up. I'll just say the current designs that they have are not locked in stone, and there could be changes, but I see my time's up.
Thank you. And I was just suggesting that maybe we can carve out a set of responsibly run SPACs and let the market, let the Wild West try to develop new and more efficient models. And my time is up and yield back.
I believe next in seniority orders, Mr. Davidson.
I thank Chairman Sherman for this meeting, and I really appreciate our witnesses highlighting this important topic, and I've enjoyed the discussion thus far. Ms. Rodrigues, in your testimony, you stated that you do not believe there's anything fundamentally wrong with the current IPO process. But in Mr. Kupor's testimony, he eloquently pointed out that small IPOs, companies with less than 50 million in annual revenue at the time of their IPO, have declined from more than 50% of all IPOs in the 1980 to 2000 timeframe to about 25% of IPOs over the past 15 years. Additionally, he points out that companies are trying to stay private much longer. The median time to IPO from founding hovered around 6.5 years from 1980 to 2000, but now companies are staying private for 10 years or more. Ms. Rodrigues, when you look at these facts, how do you say that there's nothing fundamentally wrong with the IPO process?
Thank you for that question. I'll say, one, I want to be more precise. I think there's nothing wrong with the basic IPO process from a regulatory perspective. I think that the move to direct listings and SPACs is in part a function of companies' dissatisfaction with phenomenon like underpricing, and the fact that there's a lot of uncertainty surrounding that traditional system, wanting to get more control over it, which they can get from a direct listing or from a SPAC. I would echo what Mr. Kupor said about it's pretty unattractive to be a small cap publicly traded company, that there isn't that coverage, there isn't the trading volume. So So that's one explanation. Another explanation is it's pretty darn easy to be private. There's been so much money sloshing around. Private equity firms, venture capital firms are throwing money at these private companies.
Yeah, I thank you for that reference to the private market, and I think that'd be a great hearing as well. When you talk about public markets, you know, there's really important things. Mr. Deane highlighted some good topics on dilution. My colleague, Mr. Hill, a bill that I'm a co-sponsor, highlighted one of the barriers to participation in our markets with accredited investor rules. And frankly, Mr. Himes did a nice job talking about reference price, which you alluded to here. All a big deal in terms of affecting value for not just the companies that launch, but the people that invest in them. And so broadly access to capital. But when you look at the things that are broken, the SPAC market and the volatility in it is coming in after the ICO market. If you look back a few years ago, the initial coin offering market was in kind of meltdown, and you saw some fraud. And Mr. Kupor, I appreciate you for highlighting that issue because it's heavily dominated in the crypto space.
Right.
For the structure of our market, the SEC's failed to provide regulatory clarity, and that's kept your average investor from being able to hold these in retirement accounts. What has that meant for people, and what needs to happen in that space?
Well, Mr. Davis, as you've mentioned, I think this is another example where I think we just have very significant disparity between, let's call it institutional or high net worth individuals versus, traditional retail investors, which is, for the former category, people can afford to spend a lot of money on legal counsel and understand exactly, what's the nature of these tokens. Are they securities? Are they not? What the SEC is likely to do. But for ordinary folks without that clarity from the SEC, it really does mean that they're missing out on what at least, we do believe is a really important growth opportunity.
Yeah, thanks for that. And for example, because of that lack of regulatory clarity, there is no Bitcoin ETF, though many have tried and are lingering in Never Never Land, waiting with some hope that there'll be some clarity. Maybe with new Chairman Gensler, we'll get there. But you can get a SPAC ETF. You can still buy those. So all these highlight voids in the fundamental IPO market. And I really think that the market is trying to tell us, look, the IPO market is not healthy. It's not fundamentally sound. It's broken. And everyone's trying to find a path around that. Lastly, I want to thank Ranking Member McHenry for his bill for Reg CF. And I think just the promise that has offered for crowdfunding should be looked at as a model that we could expand to provide broader access and more democratic access to capital. The last thing, we haven't spent much, and I'm running low on time, is direct listings. And I think, Coinbase's direct listing highlights that it can be a viable model in all important areas. And I thank everyone for helping us get to this point in the hearing. I yield.
Okay. We have 5 more questioners. We'll be done in less than half an hour, unless there's a general consensus to do another second round of 2.5 minutes per member. And so if you have a view on that, please text me. And why don't I recognize Mr. Vargas?
Thank you very much, Mr. Chairman, for holding this hearing. And I especially want to thank the witnesses today. I think the most important question that came up today was, what about weddings and marriages? Well, let me tell you, I'm going to give you the answer right now very clearly. It doesn't matter if it's a wedding in Vegas or a traditional wedding. If you want to make the marriage work, you love your spouse and you don't cheat on them. I've been married for 30 years. It works great. Okay? There, that one's been asked and answered. So now we move to this. The way that traditionally we hold a hearing is that whatever parties in power has, 2 or 3 or 4 witnesses, and then the ones in the minority have 1 witness. And normally they don't agree on things. That's why you have the disparity, which is fine. But I think we may have found something that everyone agreed on today. I think, and that's why I want to pursue this line of question, and that is the issue of liability. I think Mr. Kupor said we should have the same liability system for all of these. So Section 11, as I understand it, is a strict liability regime. So issuers are made strictly liable for registration statements that contain an untrue statement of a material fact required, or they omit one. So you don't have to prove causation or reliance on the misstatements. It's a strict liability statute and regime. Now, did I understand, Mr. Kupor, correctly that you agree that an IPO should have the same, that the playing field should be the same for a SPAC and for an IPO? Or am I misstating what you said?
No, Mr. Vargas. Yes, I agree that this Congress should determine. I'm not taking a position on what the appropriate liability regime should be, but I absolutely agree with your position that we should have a level playing field, and we should not have regulatory arbitrage that determines which path makes most sense for companies.
Well, that to me seems like a very big deal. I'm going to ask Professor Rodrigues. That seems to me a huge issue with these forward-looking statements, don't you?
Yes, absolutely.
Could you expound on that?
Sure. So the information, information is valuable. That's why issuers disclose it on their own, and that's why we require disclosure under the securities law. And, if you're interested in a company, you're interested in what happened in the past, but you're probably as or more interested in what should happen in the future, right? What do you think? What does the CEO and the CFO think that the prospects of the business are? And so that's why Congress in 1995 said, okay, under the Private Securities Litigation Reform Act, you have this safe harbor and we can protect you if you want to say, hey, here's what we think is going to happen down the road. But that's not for IPOs, because IPOs are this special world where the company is first coming out into the public markets. And so we have really strict liability standards. We want to make sure that everything there is accurate. There isn't any material misstatement.
And do SPACs have that today?
So they
is that
do,
liability?
because when they go public, they're just an empty shell. And what you really care about is when they find that private target and they're acquiring it. That acquisition is effectively an IPO. But in that effective, the Vegas wedding IPO, then they get to say whatever they want about about the company's prospects in a way that a traditional IPO can't. And that's just not fair, right? There's a different standard depending on which way you take.
I agree with that. Does anyone disagree with that? Mr. Park, do you disagree with that?
No, I don't. And in fact, I think this whole notion of forward-looking statements and the accuracy of that is very important. And the way that we know that is because if we look back most recently to COVID, actually, that the strength and the certainty of these forward-looking statements are very important to make sure that not only do investors have protections, but also other business owners who rely on what some of these other businesses are doing. So, for example, right, the SEC had back in April 2020 had to give guidance to a lot of executives on how to handle a very unprecedented and uncertain time as it pertains to how COVID affects their business models. And that shows how strong the protections are for public companies right now. Now, if we also think about this from another point of view, if I'm a travel agency, right, and I need to look at airlines and hotels and what they're doing, I need to trust their forward-looking statements as well.
Yeah, my time is ended, but I'm glad that we may have agreed on something here. Thank you. I yield back.
Thank you. And I'd add one more thing for a happy marriage is do not undervalue your spouse or underprice in this world. Okay, Mr. Gonzalez.
Thank you, Chairman, for holding today's hearing, and thank you to our witnesses for being with us today, and thank you to Mr. Vargas for preaching a little bit, and I enjoyed that. In any event, over the last year, we have seen significant changes in the way that retail investors of all stripes are engaged in our capital market system. And personally, I'm encouraged to see more and more retail investors invested in the market in an effort to better their lives and build a more prosperous future for their families. Of course, that's not without risk. That's how markets work. And in this case, I do think it's important that we take a step back and recognize that whether we're talking about the crypto or NFT markets or SPACs, the proliferation of riskier investments has been driven by a zero interest rate world which has resulted in a fully valued stock market and investors moving further and further out on the risk curve. I don't think we haven't mentioned that, but I do think it's important to keep that in mind as we debate what's happening in our markets. And so rather than doing what I fear my colleagues on the other side are doing, which is trying to turn off options at times for retail investors to put their capital to work and to make it harder for companies to raise capital, I do think we need to recognize the uniqueness of the moment and try to find ways to improve the efficiency and strength of our capital markets for all participants. Mr. Kupor, in your testimony, you talk about the two-tiered capital market structure, where because more companies are waiting to go public later, a disproportionate amount of value is created in the private markets, which structurally lock out retail investors. I completely agree. You also correctly point out that having multiple avenues to go public is a good thing from a competitive standpoint. And we haven't talked much about direct listings, and I want to hear from you from the perspective of the entrepreneur or the founder. When it comes to a direct listing, what is the benefit specifically of a company looking at that as a vehicle to go public? And if you could also touch on the projections that are made in that process, because I see projections when I look at the YouTube videos and things like that, but I'd love for you to just sound off on that if you could.
Sure. Thank you, Mr. Gonzalez. So yes, with respect to direct listings, as mentioned before, typically the companies that are choosing this route are ones that don't have a need for primary capital. So they're able to, again, avoid dilution, quite frankly, that you would have in an IPO process. So that's very positive. The second benefit to direct listings is they utilize what I would call more of an auction mechanism to actually try to derive the opening price for the stock. And we see a little bit of advancement here in the traditional IPO market. So there are some banks, trying to do a modified auction process, but the kind of process that goes through in a direct listing is still a much more robust process. And so therefore, for people who are concerned about potential underpricing or things of that sort, there's probably a closer market price and a better way to discern that market price that happens there. So it's been very positive. As I said, look, the reality is we've had very few. We've had about 6 of them in the technology market. So I think there's a lot of work to be done there. But it also has the positive effect, as you mentioned, from a competitive perspective. It's made sure that it's forced traditional underwriters on IPOs to kind of tighten their pricing windows, which I think has been positive. And it's forced people to think about things like lockups, for example, which can create distortions based on supply and demand in the market. So I think making sure direct listings stay as a viable option, I think will also actually address some of the challenges that many of you have mentioned around traditional IPOs.
Thank you. And Mr. Deane, one thing that you talked a lot about on the SPAC side is with respect to disclosures and subsequently incentive alignment. And I think that's right in many ways. I'm personally somebody who wants to be able to take risk. I just want those things disclosed so I can understand them. And more or less, I do think you can figure out what the promote structure is in a SPAC if you go through the listings. Yes, it's hard, but I think you can do it. One thing you didn't touch on, which sort of surprised me, is with respect to the syndication of the risk capital at the pre-IPO stage, if you will. So in essence, if you're purchasing pre-merger shares in a SPAC, you're really just buying the sponsor. But my question for you, is it possible today for someone to know who owns the sponsor, or can the sponsor syndicate the risk capital such that you don't actually know?
To be honest, I am not certain with your question about it. You're asking who actually stands behind the sponsor.
Yeah, so the sponsor has to put up risk capital. Can the sponsor syndicate that, sell it off, and not disclose it?
In the pre-IPO, I would question that, but to be honest, I would like to look at it further, and if I could get back to you.
Sure. Mr. Kupor, do you know the answer to that?
I believe it's yes. Yes, that's correct.
Yeah. So the answer is yes. So I think that's another area where I think from a disclosure standpoint, we probably need to do a little bit better work. I've run out of time, but thanks again for the hearing. With that, I yield back, and thanks for the marriage advice.
Thank you. Good news for our witnesses. Our friends on the other side of the aisle do not want even an abbreviated second round, so we'll be done in around 20-25 minutes. That puts a special onus on the remaining questioners to ask brilliant and incisive questions, which is why I recognize Mr. Sendickles.
Thank you, Mr. Chairman, for the introduction. That's very kind of you. I wanted to specify a question to Professor Rodrigues. As I'm listening to this whole conversation of SPACs, I'm brought back to my my old days of when I was in the investment industry, and we were having to learn about the different types of management companies. And I wanted to see if you could really help us to understand the difference between a SPAC as we're discussing it today and a closed-end equity fund that would typically be somewhat similar in its function of pulling together investors and then going out and making specific investments or acquisitions.
Well, I don't know that I can. I think a closed-end equity, if you could describe a closed-end equity fund a little more to me, then I could probably take it from there. But thank you for the question very much.
Well, I mean, I just wanted to put it out there. Maybe Mr. Deane can elaborate perhaps on what the differences are between a closed-end equity fund and a SPAC.
Well, again, I'm not, if I understand it, they're closed-end mutual funds. I'm not quite sure, but if that's what you're asking, they would own assets. They would buy, they would invest in different things. And it would be closed end, but it would still be like, other than that, it'd be like a mutual fund, and it would have a diversity. It would probably have a diversified portfolio. And you could look at it and see what those assets are. Now, in a SPAC, it's different because first, at the very beginning, at the IPO, the SPAC is just saying, I'm out there, give us some money, we're going to go find a great deal, trust us. There are no assets other than the money that comes in. And a second point, they do find a merger target, but at that point, it's just one company, private company, that they're taking public. It's not a diversified portfolio, it's just a risk on one company. That's really the best I could do to respond.
So when a SPAC is being formed, do the investors in the SPAC know what company is being targeted for acquisition?
No, Congressman, they do not. A SPAC might say, we're going to look at EV, electric vehicles, or we're going to do something in the tech space or the biotechnology. So you might have an idea of what sector it is. But the question is, do they identify a specific company that they plan to take public? The answer is no.
So why would an investor invest in a SPAC prior to its IPO if they have no idea what they're investing in?
That is a great question. Well,
the reason I'm asking is because there really is one of only two answers. Either one, they do know what they're going to invest in, and then we're talking about some serious potential insider trading, or they don't know what they're going to invest in, but they're investing because of the management team of the company. But then we're talking about open-ended or closed-ended management companies that really should be under the regulation of the Investment Company Act of 1940. And so I'm sitting back and I'm looking at SPACs, and it doesn't really make any sense to me as to why they would be, treated as a typical IPO, a typical company that's being formed up under the equity markets. They really sound like they're either forming up under the status of management companies and trying to skirt around the Investment Company Act of 1940, or two, they actually know what they want to invest in advance. And then we're talking about insider trading and a bunch of investors knowing what they're going to go after and kind of structuring the entire acquisition in a manner that's going to guarantee that all the players are going to make a certain amount of margin at the expense of retail investors. Professor Rodrigues, do you have anything that you'd perhaps like to add to that analysis?
Yes, that was very helpful. Thank you to Mr. Deane and to you. Yeah, so the idea is, in theory, that it is a bet on management, that the management either has this experience in private equity that makes it able to identify some attractive target, or it has public company operating experience that can help shepherd the company once it's identified. I will say that in the studies that study that I'm doing right now, sometimes there are multiple targets that wind up being acquired. It isn't just one company, it's two or even three that are sometimes related and sometimes not.
And just to close, because my time has expired, Mr. Chairman, perhaps we need to regulate SPACs as management companies and not as, equity IPOs. Thank you, Mr. Chairman. I yield back.
Chair will advise members that if I cannot see your face on screen, that I cannot call on you when your turn arrives, but Mr. Emmer's face is definitely on screen and he's recognized.
Thank you, Mr. Chair. Participation in the IPO process has significantly slowed over several years. The number of IPOs declined more than 63% from the 1990s to the 2000s and has stayed flat up until 2020. What's interesting is that at the same time, the United States has doubled the regulatory compliance costs a business has to take on for going public in a traditional IPO. It costs an average of $2.5 million for a company to achieve initial regulatory compliance for going public, and an additional $1.5 million annually thereafter. These are the SEC estimates. This is just not feasible for our small and emerging growth companies. These businesses are turning to more streamlined approaches to access capital, like SPACs, direct listings, or even staying private. An overburdensome IPO process hurts American consumers by limiting their access to the markets and ensuring that only institutional investors can invest in these innovative emerging growth companies. It's critical that our capital market structure meets the needs of American companies, regardless of their size or type. I'm excited that we're going to reintroduce my bill, the Main Street Growth Act, which passed out of the House in the 115th Congress and passed out of this committee unanimously, thanks to my colleagues on the other side of the aisle, many of whom are present with us today. This bill will allow the SEC to provide for the creation of venture exchanges. These specialized securities exchanges offer streamlined regulation and strong investor protections, which will help small and emerging growth companies gain access to capital, create jobs, and help the economy rebound. Mr. Kupor, in your testimony, you note that fewer small companies than ever are going public. But the good news for capital formation is that there are now multiple choices for companies that are considering going public: traditional IPOs, direct listings, and SPACs. Given the current landscape and the importance of having new companies join the marketplace, can the creation of venture exchanges help incentivize more emerging growth companies to go public?
Thank you, Mr. Emmers. And I appreciate that. And yeah, you and I have discussed this a little bit before. The concept of a venture exchange, I think, is a very good concept. And the basic idea being, look, how can we address from a regulatory perspective, and then importantly, from an aftermarket perspective, the things like liquidity and volume of trading that can impact small cap stocks. And so the concept makes a lot of sense to me. I think, the devil is in the details, as you and I have discussed on these things. And, what we want to make sure is we don't create kind of adverse selection risks associated with companies that might choose to list on a venture exchange relative to the traditional markets. And again, these are issues you and I have talked about before. Some of the experience, for example, in the AIM markets in the UK have exposed some of those challenges. So making sure that the venture exchanges don't create that, and that there is a seamless opportunity for companies to effectively graduate over time from a venture exchange into a more traditional national market exchange as we have today, I think would be important to ensure high quality issuances in those markets.
Just following up on that, can you elaborate a little bit more and speak to the importance of facilitating a competitive marketplace where small and medium-sized companies can be attracted to investors, since that marketplace is currently dominated by larger cap companies?
Yeah, it's really important. And I think the issue goes back to, I think one of your colleagues mentioned, which is we've taken a bit of a one-size-fits-all approach to regulating companies. And look, many things that work well for large companies just don't work well for small companies. So we really need to do that. And look, to me, competition is great. I mentioned before, we're already seeing changes to how underwriters are doing pricings in traditional IPOs as a result of direct listings and SPACs being viable alternatives. We're seeing reforms around how people think about lockups, which also, as I mentioned, create strange, trading dynamics in these companies. And you would expect that also may impact pricing, quite frankly. So what the fee structure, which I know many people have talked about on this committee. So I think the last thing we want to do is restrict choice. Clearly, we should make sure that things are regulatory compliant and that are available to others. But if we do something that kind of constricts the choice for issuers, I think we will lose on a lot of these great opportunities.
Wow, I appreciate that. Mr. Chair, I yield back.
Thank you. Now recognize the new vice chair of our committee, who brings a tremendous business and financial experience to that role, for his first questions as Vice Chair, Mr. Kessler.
Thank you so much, Mr. Chairman. I'm looking forward to the responsibilities you will be assigning me. It strikes me that on this committee, a lot of times we talk about trends in capital markets as if the investors are static and they only reflect changes in companies' access to capital. We all know that's not true. Over the last 3 decades, we've seen transformative changes in the institutional sector, the pension funds, the endowments, who used to have all their capital in treasuries and utility stocks and have now, created these whole investor classes, alternative investment classes and REITs and private equity and venture. And that is awesome. It has completely changed the market. It's created opportunities where companies like the company I used to run that were really too small to go after private markets still had access to capital. And that's a good thing. It has also created an entirely new class of actors in our financial markets. There used to be owners of wealth and people who needed wealth, and now we've got custodians of wealth in the middle. And some of them have done a great job, some of them haven't, but it's changed the dynamics. There's nothing wrong with that. I sort of view SPACs and pipes as things that live in that continuum, right? Because every company that's got a single large sophisticated investor would love to still have the access to capital with a less sophisticated investor. It makes your life easy as a manager. And I think the challenge of regulation is always trying to figure out how to ensure that access to capital survives, while at the same time not taking advantage of unsophisticated investors. And so my first question for you, Mr. Park, is you mentioned that a challenge with SPACs is that they're putting their trust in a sponsor rather than the company. Isn't that essentially the same thing that happens when investors invest in a private equity fund? Is there any fundamental difference there?
Well, Vice Chair Kasten, the major difference between the SPAC and a private equity fund is that, again, with the private equity fund, there is going to be a debt investment where the investor has some set of security that they have, versus in a SPAC, they are the junior most, if there's other debt, type of investor there. I should also kind of point out that there are some significant differences between kind of how SPACs work and also some of these private equity funds. Again, part of the business model for a lot of these SPACs is that you need a lot of marketing and a lot of hype around them in order to attract investors. That's why you see the SEC warning a number of investors, don't just buy a SPAC just because they hire a celebrity to go and promote them, right? So
sure.
That's a major kind of concern there.
Yeah, no, and I take your point, and I'm really just talking about the equity investors in both, that if you view it as along a continuum, the equity investor is taking a bet on the sponsor in both cases. And I take your point. I don't mean to criticize. I just want to run through some other questions. Mr. Deane, you'd mentioned in your testimony that there's pressure to deploy capital in a SPAC before the window closes. Is that fundamentally different from a private equity fund that's nearing the end of its lockup period, has committed capital that's still undeployed?
I would say it's the same, except that a PE firm might have more years, that maybe it'll have 7 years to do it. The SPAC is usually either 18 months or 2 years. The other difference, if I could, is that a PE firm will often have a diversity of targets, a diverse portfolio, whereas the SPAC is usually, if not always, one firm, one target.
Okay, so I want to be clear that I'm in no way meaning my questions to be sort of leading and saying that one way or the other, but we've all seen the statistics that the overwhelming majority of returns in the alternative asset class space is driven by a tiny number of firms, and that there's actually a lot of dogs and a lot of people who are thought of as sophisticated investors are losing their shirt on that side. And my question for and I guess I'll start with you, Mr. Deane, because I've still got you on the screen, but capital markets are going to continue to evolve. They will evolve in response to what we do from a regulatory perspective. And if the issues are the compensation structure and the incentives, let's make sure we think about where those guardrails should be. If the issue is that there is a specific class of investment that we want to prohibit, okay, then let's do that. I just want to make sure that in thinking about the compensation structure of SPACs, the lockup periods, the deployment, I want to make sure we're focusing on the right issue. So if you were looking at the broader space of money going into somewhat less conventional structures. Are there guardrails that cross that whole continuum we should be thinking about, or is this just a SPAC issue? And I see I'm out of time, so perhaps we'll have to take that offline, but would appreciate any of your thoughts in writing after the hearing's over on that question.
Saved by the bell, but I'd be happy to respond right afterwards.
To your written response to that question, and we all look forward to the questions of Mr. Stile.
Did I hear that, Mr. Chairman? Am I up?
We can hear you now.
Very good. I look forward to being back in person. It's going to be easier. I don't know when my time is due, but I appreciate you holding the hearing, Mr. Chairman. Mr. Kupor, as you know, most venture-backed startups are emerging growth companies. Can you walk us through your analysis of some of the benefits of EGC status?
Yeah, thank you, Mr. Stile. Yes, there are several things. Number one, which we've now extended more broadly, is the idea of confidential filings and the idea of test the waters are very, very important, because this really gives the companies an opportunity to talk to investors before they have to kind of, make a final determination, quite frankly, of what the right path is, and it really is beneficial. The second thing is, as we've talked about before, the idea of reduced regulatory burdens, right? So the ability to have different, Starbucks-related requirements and other things that are, generally geared towards smaller companies. So effectively think of it as an on-ramp to becoming a public company. If we make that on-ramp a little bit easier, we're more likely to see public companies go out.
And maybe you could comment then, is talking about bringing more companies into the public markets, how that EGC structure assists companies in accessing capital. Could you comment on that?
Yeah, look, at the end of the day, what it means is if you're an investor, it just means there's more money that the company's going to have access to on their balance sheet that can go towards research and development or other important, initiatives they're doing, versus that amount of money being diverted towards regulatory expenses. So it's been very beneficial. Particularly, you see this actually in the biotech market, which has been very robust over the last several years. That tends to be a bit of a smaller cap market, at least relative to the IT markets. And I think those companies have substantially benefited from the ability to deploy capital in the most promising areas versus on regulatory structure.
So we're talking about how companies enter. How about companies that are already in EGC status, in particular those that are either have already lapsed through the 5 years or that are approaching that lapse? What the implications are of losing EGC status for some of those key companies?
Yeah, look, I think it's really the same. So, you mentioned it, but, look, if we could extend that time period from 5 years to 10 years, whatever this body thinks is appropriate, I think it has the same beneficial impact, which is think of it as you've got a fixed pot of money on your balance sheet. And the question is, where are you deploying those resources? And the more we can divert those towards productive, research and development related expenses, I think that's beneficial for the economy and it's beneficial for those issuers as well.
So you're in your view, if we extend the EGC status, that there's going to be benefits not only to the companies, but really to the R&D ecosystem, to employees, and all the way down that entire pipeline for those EGC companies and their stakeholders.
Yes, I do believe that, Mr. Stile.
But I appreciate you joining today. Appreciate you, Mr. Chairman, holding today's hearing. And with that, I will yield back.
Thank you.
Thank you. We now turn to the distinguished chair of the Housing and Insurance Subcommittees, a senior member of the full committee, Mr. Cleaver.
Thank you, Mr. Chairman. I just have one question. I think most of the issues that I was concerned about have been raised by the members of the intelligentsia of your committee. So what I wanted to just kind of say is that I am amazed by the notoriety of our celebrity culture in this country. It's just absolutely amazing. Shaq played basketball, and now he's in the middle of giving financial advice to folks. I mean, he made a lot of money, and so maybe he learned a lot about money, but back in March, the SEC issued an investor alert regarding celebrity involvement in SPACs, and in the notice, the SEC, warned individuals never to invest in a SPAC based solely on a celebrity's involvement. And so I guess, you know, I don't know if that would stop anybody from doing it, but, you know, Mr. Park, would you agree that this trend reinforces the fact that SPACs generally represent a very speculative investment?
Yeah, absolutely, Congressman Cleaver. And that's a great point that you raise. What I find really noteworthy about how SPAC sponsors are relying on celebrities to promote themselves is that they're implicitly saying that by doing so, they think that they can attract retail investors to invest in their SPACs just merely by the association alone, right? Rather than on the merits of their business model, their financial statements, or, you know, or really looking at it, you know, in any kind of substantive way. And what's kind of, you know, notable about this too is that, you know, hiring celebrities really isn't a new strategy. I mean, we've seen celebrities being used time and time again to promote different types of financial products, whether it's reverse mortgages, you know, I guess annuities, and or different, you know, lately different cryptocurrencies too, right? So I think that is kind of very noteworthy. What I'll also point out is that sometimes, you know, the issuers can also have a bit of a celebrity status of their own, and that can also lead to some poor investments that way. You know, I think of, you know, for SPACs, the perfect type of investment that goes wrong is that a company that's, you know, heavily hyped, you have a very compelling narrative around the founder, and, you know, it also really appeals to kind of our desires for a product or a company that will really improve the world. But the problem is, you know, sometimes we can find that it's fraud. And the example that comes to mind for that is Theranos, right? Who kind of meets all the criteria of that, and unfortunately just built a bunch of different investors, some of whom were more sophisticated than your average retail investor.
Well, no, thank you very much. This is an all-day conversation because I at least for me, because I'm just amazed at what what will go on. I'm not sure that the statement issued by the SEC is going to do anything by it in and of itself. I mean, we are almost worshipful when it comes to celebrities in this country. So anyway, thank you, Mr. Park, very much. I yield back, Mr. Chairman.
I want to thank all my colleagues for participating in this hearing, particularly those who are here at the very end. I want to thank our witnesses for their testimony. I want to reiterate that all members have five legislative days within which to submit additional written questions to the witnesses. All members will have 5 legislative days within which to submit extraneous materials for the record, and you all have the email address to submit either of those. With that, the hearing stands adjourned.